Good day to you, my wonderful student. Once again, I am Mr. Olawale Benishola, your commerce teacher, and welcome to today's lesson. Once again, this video is brought to you by Egota Virtual Learning. Today, we will be exploring another critical topic in our WAEC commerce syllabus. We are diving into insurance. Yes, the last time we treated a topic on insurance was under banking. This time around, we are moving further into types of insurance and other aspects of insurance. Now, I want you to know that insurance is an essential financial arrangement that provides protection against potential financial losses in Nigeria. As our economy grows and citizens acquire more assets, and understanding insurance becomes increasingly important. Up next, let us talk about our lesson objectives for today's lesson. Now, by the end of this lesson, you will be able to, number one, differentiate between the various types of life insurance, including whole life insurance and endowment policy. 2, identify and explain different forms of non-life insurance, such as motor vehicle, fire, fidelity, burglary, accident, consequential loss, and marine insurance. 3, you'll be able to distinguish between insurable and uninsurable risk. 4, categorize risk as fundamental, pure, particular, or speculative. And lastly, we will be able to apply this knowledge of insurance to real life scenarios, and we are also going to practice some WAEC examination questions. Now, before we move deep into our lesson objectives, let me quickly remind you what actually is insurance. We said earlier on that insurance is like a backup plan against risk. Now, insurance is part of an essential financial arrangement that will provide protection against any risk in financial business, in financial losses, especially in Nigeria. As our economy keeps growing and citizens keep acquiring more assets and properties, it is important that you must understand insurance, as it will help you to guide against financial losses. Now, we are moving to types of insurance. Talking about types of insurance, let us start with what we called life insurance. Now, what actually is life insurance? Now, life insurance is like a contract between an insurance policy holder and an insurer, where the insurer promises to pay a designated beneficiary a sum of money upon the death of the insured person. We can also go further to explain that life insurance provide financial compensation to the policy holder's beneficiary in the event of death or after a specified period. It focuses on covering a human life. Now, what implies is that a life insurance is kind of a package for next of kin or beneficiaries of someone who goes to an insurance company to kind of have an insurance plan on his or her own life, that after the person's death, that the insurance company will have to pay the next of kin or the beneficiaries, maybe 1 or 2 or 3, some particular amount of money based on an arrangement in percentage to the next in line, to the insurance holder, to the policy holder actually. Going deeper into life assurance, what are the specific parts of life assurance? Now, the next one we are going to be looking at is whole life assurance. Now, whole life assurance provide coverage for the entire lifetime of the insured person, as long as premiums are paid. Now, this combines insurance protection with a savings component. Now, this policy covers the insured person for their entire life. Now, premiums are being paid. Now, premiums is the actual money that the insured person pays per month or a particular period. Now, these are paid until the person's death, after which a lump sum of money is now paid to the beneficiary. Now, whole life insurance is a kind of a particular activity, a particular aspect, a particular process whereby a person, an individual, will walk up to an insurance company and tell them, oh, I want to insure my whole life in form of a savings, in manner of savings. So you, the individual and a particular insurance company will come up to agreement. Oh yeah, okay, these are the kind of plans that are available. Now you can be able to be paying a particular sum of money like 30,000, 40,000 per month, after which the person dies. The lump sum of the entire money, that is the total money, is now paid to the beneficiaries. Now, for example, now let me give it for example now. Mr. Adebayo, a 35-year-old banker in Lagos, takes out a 10 million naira whole life policy. That means that it will be paying 250,000 naira annually. As I've said earlier on, which I said periodically, it can be per month, it can be per year. But Mr. Adebayo in example says, okay, he will be paying a sum of 250,000 naira annually. If he passes away at a point, his family will receive, that means his entire family will now receive an entire 10 million naira in total. Now, additionally, the policy builds cash value over time that Mr. Adebayo can borrow against on withdrawal if needed. Now, premiums are paid until death, after which a lump sum is paid to the beneficiary. Now, it provides permanent coverage and is built cash value over time. Now, it's useful for long-term financial planning, estate taxes, or inheritance. Now, it's also, premiums remains the same throughout the policy. Now it's some policy actually pays dividend to policies holder. Now another example, let me give another example for you to understand what actually is whole life insurance. Let us take another one now. Mr. Ade takes a whole life insurance to ensure his children receive money for education if he passes away at any time. Now, that's another example of whole life assurance. Let's talk about endowment insurance. That's another part of life insurance. Now, endowment insurance is a life insurance contract designed to pay a lump sum of money after a specific period on its maturity. Now, when we talk about the maturity, that's the policy runs for a specified term. Example, we have 10, we have 20 or 30 years. Now this one is a contract on life, all life insurance that is for life. Now this one comes at a particular period that the sum assured is paid either on death within the term or at the end of the term. If the insured survives, it serves as a form of investment and life protection. Now for instance, now I'm going to take two examples as usual, just like whole life insurance. Now the first example that I have here that I'll be talking about, let us look at Miss Okafor. Now Miss Okafor is a teacher in Enugu. It takes out a 20-year endowment policy for 5 billion. Now when she is 40 years old, if she survives till age 60, she receives that 5 billion naira. Now, if unfortunately she passes away before reaching 60, her beneficiaries receive the 5 million naira. Now, let's take another example. Mrs. BC takes an endowment policy of 5 million naira over 15 years. Now, if Miss BC dies within that period, her family gets the money. If she survives, she will be the one to receive the money as savings. Now you can see it now. It's a contract that okay, like the first one now, Ms. Okafor, that she takes a 20-year endowment plan for 5 million naira when she was 40 years old. Now for that is 20% plus 40, that is 60 years old. Now, if eventually Ms. Okafor gets to 60 years, that is 20 years plus, that is the end of the contract. Now, if Ms. Okafor gets to age 60 and she does not die, she'll be the one, she herself will be the one to receive the 5 million naira assurance money. That is the endowment insurance. But if she dies before she gets to the age of 60 years, that means her family will be the one to receive the money. Now, what are the key features of endowment insurance? We have, it combines insurance protection with savings. It is a fixed time period. Typically, we have 10, we have 15 or 20 years. Now, the maturity benefits if the insured survive the policy term. Now, higher premiums than whole life insurance. It is popular for education planning and retirement. We are still under types of insurance. Now, remember we talked about the first one, that was life insurance. Now, life insurance is basically on two. We have the whole life and we have the endowment. Now, moving on, we have what we call non-life insurance. Non-life insurance, that is the next one that we're going to be talking about now. Now, what actually is non-life insurance? Now, non-life insurance is basically talking about the other general types of insurance which provides protections against losses and damages other than those covered by life insurance. Now, life insurance covered lives, but non-life insurance covered other type of losses or other type of policies that it protects assets and liability. Now, these typically are short-term and are renewable, so we are going to be picking them one after the other. The first type of non-life insurance that we will be looking at is motor vehicle insurance. This insurance protects against financial loss due to damage or theft of vehicles and liability that could result from vehicle accidents. Now, it covers vehicles against theft, accident, or third-party liability. Now, third-party insurance is compulsory in Nigeria, which covers damage to other people's property and other people actually. Now, comprehensive insurance includes theft, fire, and personal damage. Let us take examples of what motor vehicle insurance actually comprises of. Now, for example, Chinedu, who owns a Toyota Camry in Abuja, purchases comprehensive motor insurance for 150,000 naira per year. Now, when his car is damaged in a flood, the insurance company pays 1.2 million naira for repairs. Let me give you another example again. If David's car hits another vehicle, now third-party insurance will pay for damage to the other car, which implies that the first one, Chinedu, owns a Toyota Camry. I'm explaining the example now, and he purchases a comprehensive car for 150,000 naira per year. Now, per year. Now, when his vehicle is damaged in a flood, the insurance company pays him 1.2 million naira for repairs. That means that he took a insurance policy on motor vehicle for his car and is paying a 150,000 naira per year. Now, the insurance company will now pay him 1.2 million naira for the repairs that has cost him in the flood, which his car has been damaged during the flood. Talking about the second example, which is David. Now, David's car was based on third party. Now, third party, David was one that commits the crime. Now, David insurance company will now have to pay the other victim a sum of money for the damage David has done to the other person's car. Still under non-life insurance, we are moving on to fire insurance. Now, what actually is fire insurance? Now, fire insurance provides protection against losses caused by fire, lightning, and explosion of gas. Listen again, caused by fire, lightning, and explosion of gas, as far as it will cause fire, which is used for domestic purposes. Now, fire covers loss or damage that are often taken by fire. Now, this insurance is often used by homeowners, landlords, and business owners. Now, it's time for example. Pay attention carefully now. For instance, Miss Bello owns a fabric store in Kaduna Market and pays 75,000 naira annually for fire insurance. When an electrical fault causes a fire that destroys all her stocks worth 3 million naira, our insurance company will compensate her for the loss. Now, Miss Bello pays 75,000 annually, that is yearly. If a fire caused, now you can see that a fire started caused by what? An electrical fault. Our insurance company must compensate her for the loss. Let me take you for another example now. A supermarket in Lagos insures its premises, that is the entire properties and everything in its compound. Now, if fire breaks out, the insurance company will also compensate the loss of everything that was in the compound. Up next, fidelity insurance. Fidelity insurance protects businesses against losses caused by dishonest acts of employees, such as theft or embezzlement. Now, this one is a kind of an insurance against an employee that has been employed in a company whereby the employee performs fraud, dishonesty, or a way of embezzlement of funds. Now, this protects employers against financial loss due to fraud, dishonesty by their employees which they employ. For example, Unity Bank purchases a fidelity insurance to cover potential loss from employees for fraud. When an accountant embezzles 2 million naira, the insurance company reimburses the company. Now, this is useful for companies handling large cash or sensitive transaction. If a cashier embezzles company funds, the company, that is the insurance company, must reimburse the employer. Now, what are the key features of fidelity insurance? It covers financial losses due to employees' dishonesty, can cover individual employees or groups. Premiums depend on nature of businesses and control in place. Now, this is essential for businesses handling cash or valuable inventory. Up next, burglary, robbery, theft insurance. Now, this insurance covers loss or damage to property due to burglary, robbery, or theft. It also covers loss due to forced and illegal entry into an insured premises. Now, this is often taken by homes, shops, and banks. For instance, Mr. Ugu's electronics shop in Onitsha is broken into at night and goods worth over 1.5 million naira are stolen. His burglary insurance covers this loss. Another one is, if robbers break into a boutique and steal goods, the owner gets compensated. Now, what are the key features of this? It covers loss of property due to forcible entry, may require security measures like alarm or guards, often includes damage to premises during theft, excludes employee theft, covered by fidelity insurance. Next, we have accident insurance. Now, accident insurance provides compensation for accidental injuries, disability, or death. It covers bodily injury, death resulting from accident, can be personal or group policy. A construction worker covered by accident insurance, get medical expenses paid after falling from a building. Now, another one, Ms. Adeyemi purchases personal accident insurance for 50,000 naira annually. When she falls and break her leg requiring hospitalization, her insurance company pays her medical bills of 350,000 naira and a weekly benefit while she's unable to work. The key features: provide lump sum payment for permanent disability, offers weekly benefit for temporary disability, covers medical expenses due to accident, no need to prove negligence by any party. Up next, we have consequential loss insurance, also known as business interruption insurance. It covers financial losses suffered by a business following physical damage to its property. For example, when Sunshine Bakery in Port Harcourt suffers fire damage and must close for 3 months for repairs, their consequential loss insurance covered lost profits and continuing expenses like staff salary during this period. Now, the key features covers profits that would have been earned if no loss occur, pays fixed costs that continue despite business interruption, usually taken along with fire or other property insurance. Now, the indemnity period can range from 3 months to several years. Marine insurance covers loss or damage to ships, cargo, terminals, and any transport by which property is transferred or acquired between points of origin and destination. For example, Dangote Group ships cement to Ghana and insures the cargo for 50 million naira. When rough seas cause some cargo to be damaged, the insurance company compensates for the loss. Now, key features: number one can be marine cargo insurance. This covers goods, or marine hull insurance, which covers vessel. Now, the coverage of marine insurance coverage are available for inland transit via road or rail. Can be specific voyage policy or time policy. Now, it is important for import and export businesses. Moving on, let us talk about types of risk. Now, risks refers to the uncertainty of an event occurring that could result in losses. Understanding different types of risks helps in making insurance decision. The first risk we are looking at here is insurable risk. Now, an insurable risk is one that insurance companies are willing to provide coverage for. For example, the risk of your car damage in an accident is insurable because it is possible to calculate the possibility and probability of occurrence. The loss is definite and measurable. The loss is accidental and unintentional. A large number of similar exposure units exist. Now, the premium is economical visible. Let's look at fundamental risk. Fundamental risk affects large segments of society or entire communities rather than individuals. For example, the risk of flooding in Niger Delta region affects entire communities. Now, these risks are often managed through government intervention rather than private insurance. Now, the key features: impersonal in origin and consequences, affect many people simultaneously, often consider society's responsibility. Examples include natural disasters, war, and inflation. We are still under type of risk. We have pure risk. Now, pure risk involves situations where there is only the possibility of loss or no loss, but no chance of gain. For example, the risk that your shop may catch fire is a pure risk. Either you suffer a loss or nothing happens. You can't gain from a fire. Now, what are the key features of pure risk? Only possibility of loss or no loss. Number two, no chance of profit or gain. Number three, most insurable risks are pure risk. Examples include premature death, accident, and property damage. Next one, under types of risk, we have particular risk. Now, particular risk affects individuals or small groups rather than the entire community. For instance, the risk that your specific house in Victoria Island may be burglarized is a particular risk that affects you alone and not the entire neighborhood. Now, what are the key features? Now, personal in origin and consequences. It affects specific individuals, can usually be insured against. Example includes theft, individual accident, specific property damage. We have what we call uninsurable risk. Now, uninsurable risk are those insurance companies generally refuse to cover. For example, losses resulting from normal wear and tear of machinery cannot be insured because the loss is certain to occur. The timing and extent may be unpredictable. It is considered a normal business expense. Now, other examples include risks that are too catastrophic, like war, risks that are intentional or fraudulent, risks that cannot be measured financially, reputational damage. Talking about speculative risk. Speculative risk involves the chance of gain as well as the chance of loss. For instance, when Mr. Okoro invests in the Nigerian Stock Exchange, he takes a speculative risk. He might make a profit or suffer a loss. Now, the key features include the possibility of gain or loss, usually undertaken voluntarily, nobody's forcing him. Generally not insurable. Examples include gambling, investments, business ventures. It is time, as usual, to practice some WAEC past questions on insurance. Now, this question will help you and understand the examination pattern and improve your problem-solving skills. For question number 1, I encourage you to pause the video along the line, attempt the question yourself, and then resume to check your answer. Question number 1, coming from year 2017. Which of the following is a type of life insurance? A. Fidelity insurance. B. Consequential loss insurance. C. Endowment insurance. And D. Marine insurance. The correct answer is C. Endowment insurance. Endowment insurance is a type of life insurance that pays a sum of money either on the death of the insured or after a specified period, whichever occurs first. Option A, B, and D are all types of non-life insurance. Question number 2, which is coming from 2019. The insurance policy that covers loss of profits following damage to business premises is called A. Fidelity insurance. B. Consequential loss insurance. C. Burglary insurance. And D. Fire insurance. Our correct answer is option B. Consequential loss insurance. Consequential loss insurance specifically covers losses that occur as a consequence of another insured event, such as loss of profit when a business or cannot operate after a fire or flood. Now, fire insurance, that is D, would cover the physical damage but not the lost profits. Today, we have explored the various types of insurance and risk, life insurance policies, provisions of financial protections to beneficiaries after the policyholder's death, with variants like whole life insurance and endowment policy. We have also looked at non-life insurance, which covers various risks to property and liability, including motor vehicle, fire, fidelity, burglary, accident, consequential loss, and marine insurance. We have also differentiated between insurable and uninsurable risk. We have categorized risk as fundamental, pure, particular, or speculative. We have also looked at understanding insurance is crucial for your future financial planning. When you buy a car, you will need to decide what level of motor insurance to purchase. If you start a business, you will need to consider fire, theft, and consequential loss insurance. Knowledge of insurance help you to protect your assets and manage risk effectively. For example, many Nigerian families have lost their life savings because they didn't have adequate insurance for their homes or businesses. By understanding insurance, you can avoid similar pitfalls, similar situations, and secure your own financial future. I encourage you to review these concepts regularly and relate them to what you observe in your community. Notice the insurance policies that business displays in their premises or the motor insurance stickers on vehicles. This observation will reinforce your learning. Thank you very much for your attention during this lesson on types of insurance. If you have any questions or need further clarifications on any aspect of insurance, please don't hesitate to reach out through this platform or the Igota virtual learning platform itself. Keep studying diligently.